Great to kick off today. Thanks for everyone for joining. This is Matt Neisser speaking here. We're happy to have everyone join to discuss the build to rent. And what really we're excited about is we've been able to see this space mature over the last 10 years, particularly over the last 2 to 5 years, and really share our insights as we've seen both multifamily come into the space and generally the space become more institutional over the last few years. So again, my name is Matt Neisser. I'm CEO and co-founder of LendingOne. We've been building this platform for almost 11 years now, and Jaime has been with me for the bulk of the time, so I'll let him introduce himself.
My name is Jaime Arouh, Managing Director of the Institutional Group, where we focus on our institutional lending platform, mainly focused around build to rent, and I also run capital markets.
So we'll talk a little bit about LendingOne so everyone has a little bit of context of why we're here today and why we hope can provide some insight into the build to rent space. We've been around, as I mentioned, for about 11 years now, founded in 2014. We were founded out of a single family office. We thought the space was very attractive on a single family basis. This was when Invitation Homes, Colony, First Key, all were entering the space. This comes out of the financial crisis, REOs. Originally, the bulk of who we were financing were regional and local investors that were aggregating single family rental. That's when we built the business. Fast forward to today, we've really created a platform, one of the largest in the country, just focused on build to rent and single family rental investors. We have 120 employees. We're based here down in Boca Raton, Florida. We did come down here in 2015 pre everyone else from New York coming down. So we have been in Florida now for about 10 years. We've built a platform really around, I think, really quality, both of our sponsorship of who we're able to work with, reputation, and that's what's allowed us to originate over $7 billion in loans just in the single family and build to rent space. And for us, that's a national reach, 40 plus states. As I mentioned, headquartered in Boca Raton. We also have an office in New York, and we have an office in Charlotte. So effectively, we lend to investors all around the country. Last year, we were fortunate enough to be named Build to Rent Lender of the Year through IMN. We're very active in the community, and hopefully, if you're in the build to rent space already, you're familiar with us. If you come from a commercial real estate background, it's probably less likely that you know us because we are not active in that world. And many folks, when they enter from CRE into the build to rent space, are happy to learn that there are lenders and platforms that are just built around this strategy. I won't spend a lot of time on LendingOne milestones, but I think the fast forward here is we've really continued to grow the platform. Each year, it's really of how can we be more effective for our clients. Originally, we were one of the first platforms in the country to launch a 30-year rental, and this is on the DSCR side. So this is landlords. Only banks provided this type of product. We realized as these institutional investors were buying scattered SFR that it really gave us an opportunity to offer a program. So happy to say we were one of the first to sort of recognize the single family rental space and how big that could become. Fast forward to effectively 2021, we took in, sold the business, running a global asset manager has really allowed us to provide very, let's call it, scaled capital to institutional. That's slightly after that time frame when we really scaled the institutional lending group that Jaime runs. That's primarily focused on build to rent strategies. So largely commercial real estate operators that have come into the build to rent space in the last few years. And we'll talk a lot more about build to rent and what that means. Coming from the commercial world, when I was at conferences 3 years ago, few people knew what I was talking about. The nice part over the last couple of years, we've really seen that pick up steam and people understand what we're doing. The company's built in 2 divisions. For the folks that are on this call, really the institutional lending is what's relevant, and we're focused on providing capital to sponsors, primarily in the build to rent space. That could be family offices, home builders, developers, and a lot of private equity sponsors that are backing clients here. The interesting part, which I think people are hopefully tuned in for, is what is this build to rent market? Where did it come from? Why is it relevant? If you're in multifamily today, why would you take interest in doing build to rent? And there's a couple of core reasons why really this one stuck out to us immediately was what's going on in this country today. And the average first-time home buyer, if we just look at the chart of the age, so historically we were, obviously in the 80s, we're in the 20s. There's a couple sort of shifts from a macro basis. That's household formation, marriage ages, living in cities, those things that you could say from the average age in the 20 into the low 30s was all related to those macro and I'll call it just population and societal changes. When we look at what's happened when this line chart goes up from 21 in a straight vertical line from 35 to 40, we now are talking about really affordability in the country and what is happening. So for us, it's become clear whether you're built to rent or multifamily, renting is becoming a primary source that first-time home buyers are staying on average more than 10 years longer in the renter sort of market. Again, I think the bulk of the country is served by multifamily for that. And Jaime can walk you through a number of other items. There's the rapid growth we've seen on the rental demand side.
Yeah, and we could see, the green lines here are home ownership, and the blue lines are rentership. So these are households that are either owning or renting. And you can really see since 2022, when interest rates came off of their lows, you can see a big shift in reduction of homeownership and increase in rentership. And the main reason for this, in addition to the macro factors, is really affordability. Home prices have increased a ton since COVID, and rates have increased since 2022. And the combination of those factors has caused the cost of owning a home to far outpace the cost of renting a home. And here you can see that demonstrated even further. So on the chart on the right-hand side, the green line shows the cost of ownership. The blue line on the bottom is cost of apartment rent, and the purple line in the middle is cost of build to rent, single family rentals. Some of the difference attributed to the difference in apartments versus build to rent or single family rentals is obviously the size of the home that you're renting. So just given that, the single family homes are more expensive and they're larger, of course, the rents are going to translate, into a higher dollar amount. But, the big focus here is the cost of ownership has really skyrocketed versus the, cost in renting. And that has driven a large portion of the population to either postpone buying a home or, maybe, just forget about it altogether. So that has really, attributed to the rise of build to rent. And then as the age of those first-time home buyers has also extended into high 30s and 40, generally those are people who have younger families already, in their 20s and 30s. Maybe that's not the case, but now in the 30s and 40s, you've got families. You clearly need more space. In the apartment space, most units are going to be one bedrooms or two bedrooms. You're not going to be able to accommodate your entire family, and then layer in the fact that people are working from home more. You might need an office. That's really has people set their sights on having a bigger space to live in, have better schools for your kids to attend, hopefully have amenities like a backyard and a garage. And that's really what has, kicked off this build to rent boom, in our opinion.
Yeah, and when we talk to most of our built to rent developers, and again, Jaime and I have had hundreds of meetings over the last 10 years with various groups and size and shape and form and around the country. Most of them really boil it down to is a backyard and a driveway, but particularly the backyard is a big differentiator that obviously the build to rent product has. And as Jaime mentioned, really over post-COVID, people being comfortable moving out into the burbs a little bit more from sort of city center, having that ability to work from home and being in the house longer with family members realize I need to have a dedicated office or at least an area that I'm doing these type of Zoom meetings in. So that's why the product mix, most of build to rent is 3 unit, mostly is 3 unit assets. There are some developers that do more 4 and 5 units to really both handle the children and the work from home aspect, but that's where we've really seen a mix change comparatively to the multi side.
Here, we kind of demonstrate the, footprint of where we're seeing a lot of the activity. And I think is driven by, two main factors. And the prevalent one is, where are we seeing kind of the in-migration, right? So our clients are looking to build in areas where, over the long term, you're going to see a trend of people in-migrating. And, generally that is, it's going to be where their employment drivers. People have been migrating to warmer weather, potentially lower taxes. But you can see the bulk of the activity is in the kind of southeast. So a lot of our clients are building in the Carolinas, in Georgia, Texas, and Florida. Phoenix is a big driver of build to rent. All of these places have buildable land, right? So there is access, to add homes. Conversely, Northeast, Midwest is much less activity. There's just not, it's not buildable and not in the proximity, of where people want to live. In terms of the types of homes being built, townhomes are a big driver. A lot of this is because it provides a good balance of both space and density. But we're also seeing single family detached, villas, and cottage style as well.
Yeah, I think this is probably the biggest trend that we've seen change in the last 36 months. As Jamie and I talk to folks in the industry, and I sort of highlighted it earlier that 3, 4, 5 years ago, when I told folks that we were a build to rent lender, most of them did not know what I was discussing. So the nice part is you do have entries from a lot of the larger multifamily operators, I think for a number of reasons. One, obviously we understand where multifamily cap rates is, or have been, I should say. And there was some extra incremental yield pickup to do in a build to rent community. I think other folks originally felt, well, I'm used to a very dense multifamily. Can I manage this like the infrastructure I already have? I think many people have stepped in and realized that they can manage it with their existing infrastructure and become more bullish as they've delivered more projects and understand that they can leverage, particularly on-site management like they're accustomed to in the multifamily world. So the nice part is we've seen most of the new entrants in the last 2 years have a multifamily platform. Again, I'd say there's probably incremental between 50 and 100 basis points of incremental yield related to build to rent versus multifamily in some areas. It also is an ability to not be bidding on in comp on every deal that goes to market. You can control your destiny, build assets where you want to build assets. And then the other one that's changed a lot is the home builder space. Is home builders had a really interesting run over the last 3 years. They had amazing margins. They were really dominating the for sale market. It's the highest percentage of sales that have gone to home builders versus just a traditional seller out there. It's been very supply constrained. Most people are locked into their mortgages, do not want to sell their house. Prices are very high. So you have the highest lock-in effect of existing folks. So the home builders have actually picked up the highest percentage of home sales as a market share that they've ever had of new home sales over the last couple of years. So they've enjoyed high margin, high demand in their products. Over the last, let's call it 2 quarters, really the last quarter specifically, you're starting to see that slow down a little bit. All of them had some type of build to rent strategy embedded before, but now many of them are trying to figure out how to balance their home building expertise and this great pipeline they have. They have a very good cost of funds. They have excellent process procedures on procurement. They are great at production building, therefore their costs are probably cheaper than any of us being able to stand up and build a build-to-rent community. So the investment side, meaning private equity firms that we work with, and the home builders have started to realize there's actually a good synergy between the two. Home builder delivers a product. They can either sell a whole community to an investor, or in some instances, they might have multiple phases of community and they decide for inventory management, it makes much more sense to sell in bulk. And they might sell 100 units out of the 300 units to in one transaction versus waiting for that to sell out over multiple months. So Jaime can probably highlight some of the other things we're seeing there, but that's been a huge difference between multifamily entrants and home builders really picking up pace in the build to rent space.
Yeah, and I think from the home builder perspective, obviously options are good. I think in the past, the typical exit was you set up a sales center, you build, you have 150 or 200 homes that you're trying to sell, and it may take a year or two for those to sell out. There's a lot of work involved, there's a lot of carry costs involved, and there's a lot of risk that you have to undertake. With the advent of build to rent and the investors who have come into the space, there's a lot of synergies in that they are able to buy a finished product from an established home builder, likely in a pretty good location, because these home builders are typically pretty targeted around where they are building these communities. And from the home builder side, they're able to save on transaction costs and obviously save time and de-risk a little bit more quickly.
Yes, I think that's the biggest change we've seen. And we wanted to include sort of the build to rent forecast to understand where how large is this trend. Clearly, just like you saw in the multifamily world, you had quite a bit of deliveries of deals that were under contract in 21 that were delivered in 23 into 24. So that's why you see sort of peak delivery there. And then it tails off a little bit, similar probably to the trends that you see in the multifamily world. It seems that the pace has held a little bit stronger than multifamily. When I talk to my friends that are developers there, obviously construction capital really evaporated for a period of time. In the built to rent space, the capital was still available, so I think that's why you didn't see the pipeline came down, but not as pronounced as quite on the new construction on the multifamily side.
I think just to add to that, because there's a shortage of several million homes in the country. So even though these homes are being, purpose built to rent, there's obviously also an exit potentially to on an individual basis to an owner occupant. So, while you see kind of multifamily starts have, plummeted, the single family space, but you can see from the delivery chart, it does come down, throughout this year and into 2026, but then does start to rise again in 2027. And, fundamentally, given that there's a shortage, these homes, they'll likely be rented, but there's obviously also an offtake on the sales side if needed.
Yeah, I think that dovetails like we'll talk through why built to rent and what the trends we've seen here, but from an advantage standpoint, I think Jaime just started to touch on it. As one, we see the geographic focus and the scalability. If you are a scattered developer, if you are a scattered single family rental operator, which is really how the business started. You have the American Homes for Rent, you have the Invitations, you had Colony, Starwood merger, you have in Pretium with Progress Homes. These are institutional ownership of scattered single family rental. If they're trying to add 10, 20,000 homes to the portfolio per year, it really became challenging without delivering new inventory for that to be true anymore, because the inventory in the US shrunk. We're at the lowest levels of inventory in the country for multiple years during COVID. And as Jaime already highlighted, where can we build? That's mostly in the Southeast, so that's what you're seeing here. So Jaime, I think you touched on some of this already, but maybe just glance through geos where you see.
Yeah, again, like our biggest markets are Texas, Georgia, Tennessee, Florida, the Carolinas. Again, these are places that have seen, big upticks in migration. You're seeing employers migrate here, and there's available land, to continue building. Clearly, Northeast, Midwest, while home prices have been a little bit stickier, and rents have held up fairly well. You haven't seen obviously the oversupply that you have in the West and in the Southeast, but there's just not the buildable land there. And I think just generally speaking, anyways, you're seeing the trends kind of move south and west. If you look at the West Coast, you see the 19,000 units under construction. Something like 11,000 of those units are actually in like the Phoenix MSA. So it's pretty heavily concentrated in that area. But other areas we're seeing have been Denver and Nevada, but Phoenix, kind of dominates.
Yeah, and I think we can probably, Jamie, if you could walk through this one, really, when we say superior valuation model, we probably have to explain, but maybe you can
Yeah.
walk through what we mean by this.
Yeah. So, what really intrigues us about build to rent is the fact that while these are single family homes, build to rent is really treated as a, or can be viewed as a commercial asset. So in multifamily, you're building it, you're renting it, and the objective is to really maximize the cash flows and the efficiencies of the operations. And the value of that multifamily apartment building or community is purely based on the cash flow that it generates and the cap rate that the market dictates. In build to rent, you kind of have the best of both worlds. So yes, it can be valued on cash flow and generally is valued on cash flow. And the objective is to maximize efficiencies, in both expenses and in revenues. However, you do have the option of a retail sales exit as well. So as you kind of in different markets, the highest and best use might vary, right? So from an investor's perspective, depending on the time horizon and the exit strategy, the best exit might be to sell it to an institution who's going to run it like a multifamily and value it on a cash flow. But we've also seen certain areas where our clients are now taking advantage of low supply, and they're selling these units off to individual buyers who will live in them. And in many cases, you're able to get 20-30% higher than what the commercial value may imply.
Yeah, so this is what we're effectively previewing, but in multifamily, clearly you have a cap rate exit and that's it, and that makes sense. On the build to rent, we're sort of outlining option one or option two. And I'd say when rates were lower, cap rates were compressed, you had build to rent trading down. I think I remember some deals during COVID timeframe, probably trading at a 4.5 cap. So we were almost at parity at some points with the multifamily space. There's always been a slight premium. That was probably the tightest. And that was during that time frame, that's probably between 21 and 22 in a ish range. I'd say the commercial takeout was actually exceeding the residential takeout during that time frame. Between 23, 22, 23 into 24, when rates start to move and residential values still continue to rise, surprisingly to most of us, even though rates are coming up. It's probably for one of the times in the residential market where you've actually seen mortgage rates go up. Everyone would assume values came down, but we were in such a supply constrained market that that's not what happened. So even as rates went up, we still had another 15 or 20% run in values in a lot of areas, particularly in down in Florida is one is probably a good example. Northeast, we still seen price appreciation. So I think we're finally at the point where we're seeing, you say over the last 12 months, we've seen more and more assets that could trade at a premium to the resi value versus I think a cap rate basis. Is that right, Jamie?
Yeah, for sure. And especially over the last year or so, where you've seen rent uh, rents are flat and potentially slightly lower. We've seen and because of the current oversupply in some of these um, some of the hotter markets, right? You've got some oversupply, which has led to rent decreases, increased concessions as there's more competition, and because these are valued on a cap basis, generally though that is kind of in the five, call it mid fives. So you've seen the valuation on a commercial cash flow basis actually come down a little bit, while retail home sales are generally flat. Some areas higher, some areas a little bit lower, but certainly outperforming what we've seen on the commercial side.
Yeah, and I think we've started to see, I think, some of our clients. I think there's one or two I can think of that had acquired probably 1,000 units or more built to rent during sort of that 21 to 23 timeframe. And for them, as we mentioned, it was strategic that some of those communities or some parts of the community, it was a way to de-risk and de-lever themselves during and start to sell down parts of communities or full communities to end home buyers. So we hadn't seen, it was always theoretical before. Now we're actually starting to see folks actually take that strategy to fruition. We'll also see that the parallel is to the publicly traded SFR REITs, American Homes for Rent, and Invitation Homes, and folks of that nature. Also, you've seen them pruning their portfolios, often selling them to end consumers and not to other institutional investors. Was the same calculus for them exist. Again, that is a scattered strategy versus a condensed strategy in build to rent, but we're seeing a very similar trend over the last 18 to 24 months in the publicly traded SFR operators, that they also are taking that similar strategy to take advantage of strong residential values.
And just another note on that, uh, the investors and REITs who have historically operated a scattered SFR strategy, because that's kind of how the business started. You've seen them lately, as Matt said, pruning their portfolios. Generally, they've been net sellers of their older vintage existing homes, selling those off individually to homeowners, but replacing that with new production, built to rent. And you've seen a lot of these REITs partner with home builders in many cases, or create their own developments. And a big reason for that is BTR does command higher rent premium versus an older vintage home. Generally, you can maintain expenses a little bit better because you're going to have less capex and less maintenance. Typically, because you have a newer home and you're in good school districts, it tend to be a little bit stickier. So we are seeing a rotation out of the older vintage homes and into newer vintage build to rent.
So that should give hopefully a brief encapsulation of the built to rent space. Again, we're so close to it that we probably glanced over a lot of hopefully we didn't glance over too many of the basics on what we've seen and what is involved there. But at the highest level, most of the build to rent communities are probably about 150 units on average. That could be as low as 70 units and as high as 200 some. They can be we've done deals that are in master plan communities, so it could be part of a for sale traditional community. This is one section of the community that is held for rent. It can be a builder, as we said, selling part of a community that they want to move inventory on, or it could be purpose built, like many of them are, where it's amenitized like a Class A multifamily building. And I think all of those different strategies can work, and they're just like in multifamily, you have a slightly different operators, slightly different markets, slightly different strategies. I think those are the type of things that we're seeing. When we talk about where we can be helpful, and hopefully we can outline both our loan programs of where we've helped people scale up, and then two, just our knowledge that hopefully we can bring to the space when we're talking to folks, since we've been so active for so long there. So Jaime can walk through sort of the core product offerings, which should seem like a traditional commercial real estate offering. So it shouldn't sound too different. The product type is different, and the way we're able to structure it's much different, but the offering should sound familiar.
Sure. So, right, in terms of our programs, I mean, it really boils down into term financing and bridge financing. On the term side, typically these come in 5, 7, and 10-year terms. So these are going to mimic what a multifamily or commercial type loan are going to look like. These are for stabilized assets. So generally, we're targeting the communities to be 90% complete. We're going to size these to a minimum DSCR and a maximum LTV. Typically, they're going to be fixed rate with full term interest only, and a variety of potential prepayment options. On the bridge side, generally this comes in two flavors, and so we'll kind of talk about the lease up. Would be very typical of what a multifamily bridge loan would look like. This is a fully delivered community. We're closing on all of the collateral on day one, and basically providing 2 to 5 year loan, floating rate, in order to facilitate the lease up and stabilization of the community. The nuance versus multifamily is that because these are individual buildings, we're getting C of Os on these buildings as they're built, and they're actually leasable as they are delivered. So a multifamily apartment building, you have to wait until the entire building is completed before you can do any type of lease up. The big advantage in BTR is that you can start leasing these and cash flowing while you're still constructing the other parts of the community. So we provide financing that facilitates the aggregation of the homes as they get CO. So for example, if we have a 150 home community that's going to deliver 10 homes over the course of 15 months, we would close on a loan in conjunction with the first 10 home delivery, and then we would facilitate monthly drawdowns as those 10 homes are delivered each of the subsequent months until the community is fully completed. And then we'd provide another 12 to 24 months to facilitate the lease up and stabilization before refinancing into a more permanent fixed rate loan. And then our bridge to perm financing is really a combination of the two. So this will allow for the aggregation of the homes as they are delivered on the front end. So you might have a 7-year loan with 12 to 24 months of aggregation, and it'll look more bridge-like. And then once those homes are delivered and we reach stabilization, we would then convert that to a permanent loan.
Yeah. And this just gives a little bit more of the metrics. I'd say average loan size is probably 20 to 50 million right now on the communities, plus or minus. I think some of the questions I've received in the past also is obviously the pricing and where we are and how you compete with agencies. So we'll talk about that a little bit, but just as a backdrop, we are part of a large global asset manager. We have access to a number of insurance balance sheets, plus CLO and other fund structures. So our cost of funds is very competitive, and we're really able to place insurance type capital. That's why we're able to be so competitive now, particularly in the CRE space. But Jaime, I think you probably walked through the bulk of this already, but it gives people a little bit of color, probably.
That's right. Here are just some examples of deals that we've done, and we'll walk through a little bit more specifically on a few deals. But you could see, generally kind of bite size is 20 to 60 million. Typically, these are financed on a discrete community, similar to financing in apartment building. So one lender will come in, finance the entire community. Generally, these are somewhere between 100 and 200 units is kind of the right size for absorption in a given market, so you're not like cannibalizing yourself. And you can see we've done a range of different home types and different locations.
I think we wanted to walk through a few case studies because, again, it should feel like a multifamily loan, but as Jamie described, the biggest nuance to all of this is that homes are being delivered, and there's not really a bridge product that exists in multifamily lending that could parallel this. So that's why we had to really come up with a few of the different things that we've had over the years. So this is a deal, I think, in Georgia that you were going to walk through.
Yeah, so this was in the Savannah MSA. It was 155 homes. When we came in, this was refinanced off of a construction facility. It was approximately 60% occupied, uh, but the homes were fully delivered. So we came in, we provided a 70 LTV loan at closing with the opportunity to earn out up to 72 and a half LTV based on certain cash flow milestones. And this is very representative of a typical bridge loan for a community in need of stabilization. This is this is an interesting loan, and this is something that would not necessarily be able to be done in the commercial space. This is a 7-year term loan that we did for a family-owned home builder in Texas. When we came in, um, they wanted to refi their construction debt in order to lower their cost of funds. The community was 287 homes, but they wanted to get ahead of that, and they only had 247 homes built at the time, and the community was 65% occupied. What we were able to do was give them a 7-year loan so they can guarantee their interest payments over the course of that time. It was fixed rate debt. Um, but we held back proceeds on about 40 homes. So 40 homes were to be built. We came in, we gave $46 million on the initial batch of homes, and while the last phase was being constructed, they were able to continue leasing up the first phase. And then when they finished the last phase, we were able to come in, give a further advance on the remaining 40 homes. Again, give them some runway to get the property fully stabilized, and then convert this to a term loan once that happened. Generally, the requirements are that we hit 90% occupancy and a minimum DSCR, and then we have a rate adjustment that's applied once those milestones are hit.
Yeah, so it's probably more similar to like a mini perm out there, but the nuance again is that all the assets aren't even delivered yet. So we aren't doing the construction component, but they're delivering them off a construction line back into this loan. So that's where it gets relatively complicated that we're able to structure around where, it's relatively unique. Some regional banks can figure these type of things out, but usually at a much smaller scale of between 5 or 15 million, they might be able to. So at this size and this one, I think really was looking for make sure we could actually execute on this and that they could have one loan versus doing two loans and taking all the interest rate risk over the next 24 months. So this one was pretty interesting.
And this loan is representative of the aggregation bridge loans that we mentioned earlier. So this was a 3-year floating rate loan. When we closed the loan, none of the homes were actually built. And what we allowed them to do was, in this case, they were able to refi their construction debt, extremely quickly. And every delivery of homes, every month, we were able to come in and finance those completed homes. So there's a 3-year term on here. Basically, they have 12 to 24 months to deliver the homes. We came in with an initial loan amount of about $15 million. We'd ramp up to 60 million over the course of that 12 to 24 months as those homes are delivered. And really, this enables you to manage your cash a little bit better and your interest expenses on your high cost construction debt, and you can refi this into lower cost bridge debt. I'd say the other structure that this loan allows for is the forward sale from home builders. So we kind of talked about home builders selling to institutions, and many times those take form in the way of a forward sale process, right? So home builder knows that they're going to deliver a 150 home community in 2 years from now, but those homes are going to be delivered in increments of, call it 10 to 15 per month. The investor actually enters into a forward purchase agreement with the home builder to buy those homes every month as they get CO. We can then pair our debt with that and provide a commitment to take those homes down on a pro rata basis as the builder delivers our client those homes.
We've seen that become very prevalent. Again, when I was talking earlier about, you have institutional capital on one side, whether it's real estate private equity, or a 90-10 structure with some type of local operator, but still institutional dollars that needs to deploy. And then on the other side of the hand, you have the builder. The builder wants to know that if they're selling this in a full basis, that you basically just don't have a free option. So that's why they created sort of the forward arrangement of, here are the 100 assets. They don't exist yet. We'll deliver 10 a month. But the investor has made a full commitment to purchase 100 of the homes from the builder with a hard deposit. So builder feels comfortable that they can sell out their whole community. Investor knows both the cap rate he's buying to, the price he's buying to, and the schedule of when they're taking them down. But you did have this sort of mismatch of, the builder needs to know that the investor has the capital to take down this whole community. And that's why we've come in and we'll do this a forward commitment effectively, which is a facility to purchase that as it's drawn down. So I think this gives us the flavor of the most of the deals. We wanted to leave some time for some questions and not have us speak the whole time. So happy to open it up for questions at this point. I see a few have come in as we were speaking, but please go ahead. We really appreciate everyone hanging on for 45 minutes already. So please send your questions in. We're happy to answer a few that have come in, and hopefully a few more that come after as well. So I see there was actually a question about this forward takeout. I think we expanded on that effectively. Builders just hoping that the end investor has the capital and the ability to take down the whole community. I'd say there you do get, by buying them vacant, you probably pick up 50 to 75 basis points in cap rate, meaning you can buy those at probably a 6 cap, plus or minus, maybe a little bit higher or lower, depending on the market. Whereas if you were buying them stabilized, it's probably a 5.5 cap. So you can pick up between 50 and 75 basis points of entering into sort of these forward commitments on vacants. So that's one we've seen that's big differential there. I think there's a question. There was a question about what markets are most active. I think we answered that, of really the Smile States in the Southeast. The one big one that came in here, why would we not go agency? So Jaime, maybe you can provide some color on the term side, why you would not go agency, and when it does make sense, and then when we're a better solution.
Yeah, so look, some of these deals are agency eligible, but the agencies, certainly have, a much higher bar for what they will finance, and their financing has to also align with their mission. So the agencies have some requirements around what they can finance and what they can't finance, and specifically in the build to rent space. We are certainly not as picky as at an asset level and don't have as many requirements. But we also have a much easier underwrite. We don't have the same seasoning requirements that they do. For example, we'll underwrite to our interest only payment, where the agencies are going to require an amortizing payment. We generally have some flexibility around minimum DSCRs. And we can also do some trade-offs with recourse to reduce those minimum requirements even further, whereas the agencies don't have that flexibility. We have, as we've shown you some examples, much more structural flexibility than the agencies do. Um, and I think the low hanging fruit is we are much easier to work with, and we can close much more quickly. We have a full team dedicated to the build to rent space of about 25 people across business development and operations, and then also handling post closing draws on our CO aggregation facilities. So we're definitely much more hands-on, high touch, and much more flexible than agencies ever could be.
Yeah. And then there was a question about, can build to rent homes be sold off to sort of families down the road? And the answer is absolutely. I think that goes to the nice part about it. Again, this is predicated on most build to rent. When you set it up, you subdivide each individual home is actually parceled, even though it's one community. You have shared amenities, and effectively, you can just think about it as a HOA is formed, and you happen to own the whole community. So in that instance, part of the nice flexibility around this is that you are able to exit out at an individual level in the home and sell it. So yes, that's the question was, do you have that optionality there? And absolutely, the answer is yes. So that's a good one. Maybe a couple questions about sort of operating expenses or where we've seen things go a little bit. Is there any bad assumptions people have made? So agency one, we answered. There's also a question about the rent delta. So maybe if we handle sort of operating expense, what we're seeing, anything that people are maybe not performing correct on this coming from multifamily world, and then two is what type of rent delta we typically see between corresponding like a class A building down the road or something.
Yeah, operating expenses. I mean, I think the biggest ones now are insurance costs for sure, and taxes. I think the great thing about built to rent is that it is a new product, so generally maintenance costs are relatively low. Turnover costs tend to be lower because once you have a family move into a 4-bedroom home, move all their stuff in, and their kids are going to schools, typically they tend to stay a little bit longer. So those are generally look better than other multifamily asset classes. But I'd say the big ones now, and obviously the ones that get all the attention are insurance and taxes.
Yeah, that's probably the biggest one. We saw the good news is the insurance component, which I think this was both a multifamily problem and this is really all rental housing across the board. It does seem, excluding California, the rest of the country has started to figure out, particularly in Florida, we had a major issue here where rates were up materially over a number of years. There's a lot of legislative reform that really brought that into light, and this is the first year you're actually seeing rates come down, and some carriers are saying they're reducing rates this year. So that was probably the biggest surprise for a lot of folks. I think the other thing we saw in sort of 21, everyone had a lot of high aspirations of rent growth, considering still continuing at this 20% growth rate. Clearly, there still is correlation between Class A rents, deliveries of multifamily assets, and built to rent sort of rents. So if you're in an area where there was a lot of multifamily construction, that will generally put pressure on the market for overall rents, including both single family rentals and built to rent. And we saw, I think that's probably the biggest area where we saw some, as in we saw in multifamily as well, some pretty ambitious assumptions on rent growth to continue to happen, and we've really seen that flatten out. Now, the curve we showed at the beginning of the call of you had a lot of construction, and then you see that dip both in multifamily and in built to rent. Inventory levels are really coming down. So it seems to us the new deliveries have come down. We probably want to be in a time frame where that's absorbed, and hopefully we can get some rent growth again. There's another question on how do we underwrite OpEx compared to multifamily less than 30%. I'd say average. It depends on the vintage. Like brand new stuff, higher price point, say 400,000 and up in the Southeast, I do say, I think OpEx is probably sub 30%. Is that right, Jamie?
Yeah, a lot of this is, taxes drive a lot of this too. So states where there's higher property taxes, your OpEx is going to be much higher. But generally you're going to range from 30 to 45% OpEx.
Yeah, and I think it depends on, again, build to rent is probably, it depends on price point. So 200 and some thousand, which is harder to build nowadays, but in Alabama has very low taxes and you can probably be in a pretty low basis. In Texas, the taxes are material and it's very hard to have a lower operating expense just where the taxes are. So it's really state dependent. Um, there was a question, is like, how often do we see parcels or sort of assets sold off? The assets themselves, like we said, it is was part of the strategy that everyone sort of employed to say we like the optionality. We're just starting to see that now. So there have been clients that has become much more prevalent recently in saying we are selling off the community because the residential values are higher than the commercial values, and it makes sense to either for returns for the investors or delever the deal or just take some chips off the table. We're starting to see that be more.
You might also even see, uh, prior to the communities being built or while they're being built, maybe a subsection is sold, as for sale, and another section is kept for rent. Um, I think generally, people are also mindful of not having too much mix of, a rental community and a sales community, just in terms of like keeping the deal clean. If they are going to exit on an institutional basis, selling off the whole community is generally better. Um, but we do see some of that phasing where one phase might be for rent, another phase might be for sale.
Yeah, I think we'll take one or two more questions if they want to come in. Other thing I want to highlight is we have two divisions of the company. We have the institutional group here that does all the built to rent lending. And then if you happen to go to our website and go to the main number, that's not going to be the target for this. That'll be for a lot of our other type of lending. So if you are or do have interest, make sure you're calling into the institutional group, which specifically handles all the built to rent and scattered communities. So if you call in and you don't get that group, please ask for the institutional group.
We'll also send out a brochure and contact information, and summary of our loans as well, to everybody who signed up for this call.
I think there was a couple of questions on some of the smaller loans, like would we do 5 or 7 homes if they're already built? That would be more in the other side of the house. We can certainly accommodate that on projects already built. We handle folks that have 5, 10, 15, 20 unit portfolios. We can do those as one loan across a portfolio. So we're happy to help there. Probably fit another group a little bit better. And then I think there was one question, probably we should give a range of like where current rates are so people have context. So in terms of fixed rate loans, those are all spread to treasury. So right now, Jamie, if we could just give a range for
Yeah,
people.
generally going to be, call it 200 to 300 over the prevailing treasury, 5, 7, or 10 year. That spread difference will, change depending on LTV, and term of the loan, also prepay penalty type. But typically our rates are going to range from, right now, call it, mid fives to mid sixes, on a fixed rate basis. Our bridge rates, will generally range from mid 200s over SOFR to low to mid 300s over SOFR. So call it again 6.5 to 7.5% on a floating rate basis. Those spreads will be dependent on, is the community fully delivered? What stage of lease up is it in? What do the cash flows currently look like? And again, like what is the leverage? But typically, we're going to be 5.5 to 6.5 right now on a fixed rate, and 6.5 to 7.5 on a floating rate.
So I think it's good probably wrap up there. So you guys have hopefully a broad overview. Certainly feel free to reach out to Jamie and his team. They're happy to have any calls and it's we have very loose dialogue all the time in terms of, is it a good fit? Is it not a good fit? Where we can be helpful. We're happy to have those conversations. We can hop on a call or a Zoom or meet at one of the conferences that are coming up. So happy to have the dialogue with everyone. You can reach out to the numbers. As Jamie said, I believe this will also be going out in as a recording for everyone that wasn't able to stick around for the whole thing, but it's been a great opportunity to get in front of everyone. And hopefully you learned a little bit about the build to rent space, and we look forward to helping as many people as we can. So thank you.
Thank you, everybody.